Hey, welcome to the Closing Beat, everybody. Happy Tuesday, Super Tuesday to you. How you doing out there? It's Super Tuesday, and that's my phone. Would you just mind, like, shutting that? Hello? Hey, you just click any button there. Spam, you know how that goes. Hey, welcome. We're financial advisors here at Jazz Wealth, and we are campaigning for clients. I have my commercial set. You might have seen it before, but at the end, I'll share my commercial, political commercial of why we think you should join us here at Jazz. We are financial advisors for people who don't think they can have financial advisors. You go, what do you do? I don't even know what you do. Anything that touches your dough, we're happy to help with. And I do need to point out one more time that if you have your high interest savings with us, if you're one of our clients, we don't charge for this. We don't make any money off of it. But Goldman now has an app for this. So if you have your high interest savings, you want to move money back and forth and all that good stuff, you can use that, as well as if you have a line of credit. Some of you have lines of credit against your brokerage account. We do that here. And so you can access all of that inside of the portal. Just want to bring that up. Last week you had Eric on Wine and Wealth. This week will be a recorded Wine and Wealth. We're going to be talking about your March financial focus. What should it be? Every single month we touch on a couple topics. So by the end of the year, we've covered everything and you've got your dough straight. That is the goal anyways. So we'll be covering that. Just 2 things to focus on for the month of March, little bite-sized pieces that we can take, really conquer throughout the year. Try to get you all straight there. Okay. You know, we have 6 Fed members speaking. Some have already spoken, but we have 6 Fed members speaking this week. We also have Jerome Powell, the president, Fed president, talking in front of Congress Wednesday and Thursday, House and Senate doing his thing there. And so the latest from the Fed members, what we actually have there is they suggested, who was it? I forget who it was. They said, yeah, you know, there's a chance that we cut rates and then pause, that we don't actually go in a series of rate cuts. So they said, well, we'll just cut rates and see how it goes, wait a little bit, and then cut again if we have to. There's currently an 80% chance. This is why this is interesting. I promise you, there's something to it. Do the math. Figure out the Fed meetings. There's 8 a year. If we say, right now, there's an 80% chance that, or people believe there's an 80% chance that there will be a rate cut in June. Okay, that's one. If then they pause and take their time to think about, that means that the next rate cut would potentially be in September, the end of September, which coincidentally would be 2 days just before elections. So that has never happened before. It is very unlikely that they would do a rate cut right then and there around the election. So what that tells you is the odds of lots of rate cuts this year are slowly dwindling down to maybe 1 or 2. I am putting my hat in the ring with only 2 for the year. Remember, the Fed, they don't cut rates just because they feel pressure to cut rates. They do it in response to something. And right now, all the economic data does not show that there's something they should respond to. All right, let's go on over to the S&P here today. There you go. A little bit of a pullback. We talked about this yesterday. The 5-day stretch that started yesterday and will end on Friday is historically one of the weaker 5-day stretches in the stock market. And so that started to play out a little bit yesterday. And then, of course, today we got a big decline here, or at least bigger than we've seen. And so that's understandable. Remember, every single sector average or has a median return that is negative over the last 10 years if you only look at this little tiny window of time. So it doesn't mean, again, I'll say it again. I mean, I know it looks like we're pulling back. It doesn't mean the market has to fall. It just means that it will underperform itself. That's all we're trying to say here. So although the market is falling, we'll take it. I'm not complaining. It doesn't mean we're going to collapse and fall apart here. We went over the stats yesterday if you are interested. Now, one thing I want to point out, there's an ETF you can use for this. I found it so you don't have to. RSP. So what this is looking at the S&P, but weighting every stock equally. You know how I tease every now and then that NVIDIA, Apple, Tesla, Amazon and Alphabet, that they all make up almost a quarter of the entire weight of the S&P. Just a handful of names, the Magnificent Seven, if you will. Well, if you use something like this, this is the S&P, but what if it was the S&P and every stock had an equal say, meaning NVIDIA had no more say than American Airlines. Amazon has no more weight than FedEx, right? Campbell Soup, SMCI, as they make their way into the S&P there. It's called an equal weighted ETF. Well, the reason I point it out is because that actually hit new highs there, right? So that's new record highs, by the way. And so it tells you that even though we're pulling back here and maybe today was a bad day, it tells you that the majority of stocks are doing their own work. If they all are equal and not one is bigger than the other, then, and this is still trending higher, that means that broadly the stock market is moving higher with lots of participation. As opposed to what we have seen in the past where just those 7 stocks, it's like the rest of the market has a bad day and just those 7 stocks lift us. Today we saw the opposite of that, where most stocks tried to do okay, at least the start of the day, and then those 7 stocks just, suffered. And a lot of them were in the news here today, so we'll talk about that as well. Now, we have in the S&P before this afternoon, we had 70% of the stocks in the S&P above the 50-day moving average. Usually it's the blue line on my chart. I'm not sure where it's at the moment. At the start of the year, it was less than 50%. So that's another way to look and just, use a little simple data point to go, oh, so most things are trending higher. It's not like just a group of stocks are lifting us higher. That could change. It probably will change, to be honest. But for the moment, we have broad participation. Is that a good thing or a bad thing? Right? Like, oh, everything is moving up, or basically everything is moving up. So I tend to be a contrarian in this case, where I go, if everything is moving up, why am I chasing everything? Right? If every house on the planet, the value is going up, I don't want to pay more, right? So I tend to think contrarian, like, well, if everything's going up, then we're probably reaching some level of extreme and due for a resetting or a mean reversion of prices. That could be, I don't know, you'll see. But nonetheless, a short, quick lesson to show you, hey, how do you tell if the broad market is participating? You could use an ETF like the RSP. It's the most popular one, and you could say, well, that's an equal weighted S&P. It does not normally outperform. It shouldn't outperform the S&P over any meaningful amount of time because, again, it's equal weighted. How do you beat something that is not equal weighted? You don't. So we got the NASDAQ here also moving lower. And largely, if you look around, large cap growth stocks, not just the big 7 there, but large cap growth stocks, they got the selling today. Actually, it was large cap growth and small cap growth. All the selling pressure, at least more extreme selling pressure, was over there. So it's natural to see that the NASDAQ is down a little bit as well. The Dow has given back basically a week and a half worth of gains there, which, it is what it is. But that is where we stand on that one. And the Russell 2000, of course, pulling back as well. The small cap growth area was the weaker spot. It did have a little bit of extra weight on things today. I'm not sure that that's the end of it there, so I'm not sure there's a rush to just go diving in and, use up all your money or whatever. So that's that. You got bonds moving higher today, prices moving higher. That means yields going lower. That's a good thing if you're looking to take on some level of debt. That's one of the bigger moves we've seen, at least in the last couple weeks there. So I'm not complaining. That happened both on the short term and the short end and the long end of the curve, however you want to talk about that. And then if you look at crude oil pulling back as well, it's kind of an off day actually for crude oil. Tomorrow you get oil inventory numbers. That will cause a little bit more volatility over there. I do want to point out Bitcoin. Told you, you got to be quick on this one. Whenever something goes up like a rocket ship, the faster it rises, the harder and quicker it falls. This is not me picking on Bitcoin. I'm saying SMCI. Look at that one. Granted, it did still going higher, whatever. But when it gets a really like climactic parabolic rocket ship, like, half pipe looking kind of look to it, you get people that take profits quickly, okay? Because what happens? More and more of us are like, yes, can you see all the money I'm making? I don't want to give it up. I'll sell some. I'll sell some more. Oh my God, it's falling. I'll sell the rest of it. And you're happy. There's no fear there. Your greed is excessive, right? Which is not a bad thing. So I say that because obviously Bitcoin had a rough day today, erasing the last 4 days. And at one point, if you follow along, what was it? Litecoin, if you're into that stuff, gave back the entire rally at one point. I mean, that's how aggressive this is to the downside. Bitcoin pokes up to new highs, 70,000, works its way all the way almost back to 60,000. 10,000 point difference. I'll just say this one more time. If you are a client here at Jazz Wealth and you are participating in Bitcoin, not through us, but just you bought your own stuff or whatever, then I don't want to hear volatility concerns about your portfolio here because that will never happen. We don't do this. So if you get a little worried, I don't know, my portfolio is moving around a little bit, expect that I'm going to give you a little grief from a good place, right? All love involved in that, but I'm going to give you a little bit of grief and you probably deserve it. So there you go. Okay, let's talk about something else here real quick before we get into stocks in the news. There were quite a few stocks in the news today, so we will run through those. You can track the level of exposure of mutual funds, hedge funds, foreign investors, and households. That's me and you. And we have a bit of a problem here because if mutual funds get excessively committed to the stock market, those are not emotional investors. Those are people that have lots of data, lots of confidence, lots of history and experience to take that kind of risk, right? And also inside the prospectus, they're allowed to, right? So this is not somebody doing whatever they want. If hedge funds take excessive risk, that's okay. They know what they're doing, right? They're not going to get emotional. They don't sit around and cry about things going up or down. Fine. Foreign investors are historically very emotional. And then us, what we call household investors, we are historically emotional, meaning we're quick to get out of something if it's going badly, even if it's just a little drop like today. So let's take a look. What unfortunately we have, and don't let this scare you, but this is a breakdown of how investors are positioned right now, as of yesterday. So this is very current. Foreign investors have about 60% of their assets in stocks. That ranks in the 99th percentile, meaning they almost have never been more exposed to stocks than they are now. Those are emotional investors. Mutual funds, 55%. Pension funds and hedge funds included in here, I should have said that too, 52%. Yes, these guys are slightly more exposed than they usually are, but they're not emotional. Work your way down to the bottom. What do we have? 46% of U.S. households, U.S. households have 46% of their dollars exposed to the stock market. That ranks in the 99th percentile, meaning there's only like a half of another time where it's been higher than 46%. These people here, emotional. What's that tell you? If the stock market has a rough week, which, you know, it's supposed to, that's just the way it plays out. And we have people that are overly exposed relative to history, and they're emotional. Uh-oh. Do we have a recipe for these sort of really tough down days where it's really hard to bounce off of lows, right? Check this out. We're going to go to a 5-minute chart. Look at what happened all day. This is the start of the day here. Very limited attempts at bouncing, meaning people weren't willing to buy very much. They didn't see this as an opportunity. They saw it as an opportunity to sell till right at the end of the day. There was just an influx of volume at the end of the day to buy on the close. That's the way they say it in Wall Street. So when you look at this, put the week in perspective, put this into perspective, and you go, oh my gosh, look at these people here. They have the least amount of cash, ranks in the 15th percentile, meaning there's only a few other times that they had less cash on the sidelines than right now. Oh my gosh, look at the foreign investors, 8% in cash. That ranks near the bottom, meaning they're overcommitted here. They're emotional, and that could be a bit of a problem. So that's kind of your takeaway for the day. There is extreme exposure to stocks right now. All right, stocks in the news, and I'll take your questions here. This is not really a stock in the news. I just wanted to share this with you. This is kind of cool to see in real time. Somebody asked about Pfizer yesterday. Actually, I had a handful of clients ask about this lately. And we talked about it washing out just yesterday. We saw the volume. You go, okay, that tells you that people no longer interested. All these people said, forget it. I'll just sell it at this price. It's the best price I'm going to be able to sell it at. What happens today? When the market was down, and broadly, most things were actually down on the day, Pfizer finds a little bit of buying. Did it find a little bit of buying, or did it find less friction from the sellers because they all gave up yesterday? That is really cool. This multi-day lesson to talk about it first, watch it happen. My goodness sakes, I'm like the most popular guy on the planet. It's really cool to watch that. So there's a lesson. If you may be just tuning in today, go back and see yesterday right at the end of the show. Look at today at what happened. Good little lesson there for if you're ever holding a stock that makes a new low with lots of volume and seems to wash out. Is that the best time to sell? Probably not, right? All right, moving on. Excuse me. So we got Apple here, very extended in the short term. I thought this was pretty cool. I tend to be a contrarian. I like to see extended declines there. A company called Counterpoint Research put out a bit of a note / white paper that says iPhone sales down 24% in the first, what would be now 6 weeks of 2024. Okay, it's not great news, but it's not disaster news. This has actually happened before. You go back to pre-COVID, something similar happened. This is in particular over in China, which iPhone dominates in China. So that was in the news. I like the extension there. I just thought that was kind of cool as well. So I thought I'd point that out. Albermarle, hey, let's play a game, right? You know the game. We're going to play this game every day until we see otherwise. So I'm just going to go, yep, there it is. Okay. Albermarle falls apart here today. Okay. They're doing $1.75 billion in what's called an equity offering. Basically, what they're saying is they're going to offer more shares, and in reality, it's 1/20th of a position to preferred shares. That's a whole separate thing. So anyways, we're like, what are you going to use the money for? We're kind of curious. Well, we're going to use this money to expand our lithium production, which I know is kind of a catchphrase these days, in Australia and China. Okay, we're also going to pay off some debt. That was part of their thing. So let's refer to the chart. We are here. And stocks get rewarded for making the following decisions when we are here in the economic cycle. They get rewarded for strengthening their balance sheet. Taking on or diluting yourself by offering more equity is not strengthening your balance sheet. We could argue the debt thing is a little bit, but nonetheless, nope, they didn't do that. Returning cash to shareholders. Was any part of what they offered a dividend, higher dividend? Were they buying back shares? No, they didn't do that. That's what we want to see here. They said, we're investing for growth. We're going to expand our lithium production in China and Australia. Oh, I'm sorry. At this point in the economic cycle, you do not get rewarded for things like that. And so wouldn't you know it? You look over at the stock price, what's happening? So I'm not using this as a way to like tease you or anything. I'm saying that's how we know we are here in the economic cycle. How many days have gone by where I've showed you stocks that buy back shares? They could have horrible earnings. I'm going to get to one in a second. And oh my gosh, they did well because they return cash to shareholders. That's how you know where you stand in the economic cycle. Really, really cool. I just like to share that with you. Oh, let's go to the other side of the equation. Hey, Target. Mostly sales were lower. Now, I'll give you this. Inventories for them are back to pre-COVID levels. Remember, we talked about that the other day. That's important for a retailer, getting your inventories back down to lows instead of having that crap on the shelves, right? They sold through it. Probably good timing because overall their sales were a little bit lower. They did beat on earnings, but sales were weaker. Sales missed. That's normally not what you want to see out of a retailer. That would normally hurt the stock there. Guidance, okay, not great. 2 cents, I believe, below expectations. So they were at like $3 or something. Now they're like 2 something. I don't know. Anyways, why is the stock higher here today? Well, let's refer to the chart. Okay, once again, I'm being sarcastic now, right? We're here. Target says, you know what we're going to do? We're going to refire up our share purchases. We're going to buy back our own shares. Well, let's just refer to this. Balance sheet strength. No, they didn't say that. Returning. Well, that one. Okay, good. So they're doing what they're supposed to. Stock gets rewarded. Right? This doesn't have to be an overly complicated game when you get yourself dialed in. Starbucks here, the, what do you call them? The labor unions have basically wrapped up everything with the board of directors there and kind of gotten, let bygones be bygones there. Stock was lower, of course, with the market today. No help there. And apparently, I didn't get to read about this one too much, but the possible arson, not at the Tesla plant in Germany itself, but somewhere right there. So I don't have the most amount of information about this one. I sort of read about it and I got distracted. Things happen. I'll take your questions if you'd like from here, but hey, if you are looking for bite-sized financial information or are very new to investing and you go, I don't know, Dustin, I knew like 3 things that you said today, check out Haley's channel. It is called Dough Straight, and she is doing great videos there to just keep things simple. Just go take you from the basics all the way through. So I hope you will check that out. Also, coming up tomorrow, we have retailers. So this is all retail earnings type season here. Abercrombie & Fitch, Campbell Soup, Foot Locker, and United Foods. Now, United Foods can be a little volatile. United Foods actually was only up once of the last 8 earnings reports. These guys are having a bit of a tough time there. You can kind of see, you can actually see, there's the one, right? But you could see earnings down, earnings down, earnings down. So, you know, if you own that one, I don't know if you own that or not, but that's going to be just a touch tough to play with there. Remember, you have SMCI and Deckers going into the S&P, and tomorrow we have the focus on Fed Chairman Jerome Powell talking in front of Congress there. So expect some fireworks. There are usually a little something in there, but we'll see. Yeah. Hey, Tom says, is Albermarle similar to Pfizer? Is Albermarle similar to Pfizer with the flush out there? 90-10, right? I think it loses a point. I don't know. I'm not playing technical analyst guy, but I think there's room to go here. Because notice it mostly sold off and hit lows ever so briefly down here. Go to, we could probably do it. Let's see. You go to, yeah, there you go. Right at the end of the day here. See this little guy right here? When you go to something like that, what happened at the end of the day in the stock market? The opposite of this. Remember, we just showed it a minute ago. There's at least an attempt to buy on the close, usually the last 15 minutes. Last 15 minutes here, oh, no bueno, man. Just falls apart to lows and briefly stamps everybody out there. The volume obviously very high for that last moment in time for the day. So not 100% perfect there, but you could put the same argument if you like on that one. Thoughts on selling Pfizer puts? If you had to sell puts on something, there's a lot of other choices. I can't tell you specifically, but I could tell you you would get a higher return on your capital, if that's how you measure, I'm assuming that's what you do, on something like Apple. You might be able to go further out of the money, have a higher return on the capital or the margin portion of your trade for the same risk with something that's even more extended. So, you know, if you only had one to choose from, maybe something a little more active. I don't know. Eloy is very interested in today's performance. Good. I was interested in the bond market today. I thought that was a pretty, and obviously Bitcoin, that was fun to watch, but yeah. Why hasn't Unity Software joined the AI craze? I don't know. You want me to call them? I'm not entirely sure there. Yeah, let's give them a call. We'll see. I'm just joking. I'll see what I can find out there. I have not spent a lot of time looking at this guy here, although I do like a good pullback. So we will see. I love it. Okay. Tomorrow, we'll be back to do this all over again. I will say that Thursday might not be a show. Mama Jazz, I got her tickets to see Mark Anthony in concert. I got to get her there, you know, so I may not be here for that. But we'll see. For the rest of you, remember that we are campaigning for clients. We would love to have your business if you're considering using a financial advisor or you just don't like the guy or girl you're working with now. Here is my pitch with a little political twist.
The financial world needs somebody they can trust and also somebody who is professional.
If you have a snowball in your left hand and one in your right hand, what do you have? Frosty's full attention.
Eric Powell is not professional. Eric Powell is a radical political insider, despite saying that he isn't. He also definitely has ties to the Illuminati. He's on the record being a radical West Coast elite.
So I actually lived in Los Angeles for nearly 2 years.
Let's hear that again.
I lived in Los Angeles for nearly 2 years.
Unprofessional, political insider, West Coast radical elite. Dustin Tibbetts is the Southern gentleman you need and a man of the people. Justin Tibbetts, a man that would never cross the line with a joke, and more importantly, always money first.
I'm Eric Powell, and I approve this message.